Hi, this is Mr. Evans. This video is going to look at ways of improving cash flow. So just so you are aware of where we are, because the specifications are a little bit all over the place with cash flow. So the first bit we've done how to construct a cash flow forecast. We've looked at how to analyse the timings of cash inflows and outflows, and covered these terms of payables and receivables. The final bit on cash flow is right at the end of the specification, 3.5.4, methods of improving cash flow and difficulties improving cash flow. So I'll tackle those bullet points in this presentation. So, we've mentioned how important cash flow is, and I even demonstrated in the previous video how a business that is profitable on paper could even run out of cash because there's a delay between them receiving payment for the goods that they've sold, but maybe their suppliers want paying up front. Cash flow is really, really important. Unless the business has got sufficient money coming in, is not going to be able to have sufficient money coming out. And here's an example of a cash flow forecast from a previous paper, and you can see you'll immediately look at this, and the closing balance is the key one to look at, and you see, right, oh dear, between January and September this business is it does not have sufficient cash in the bank. It's got minus figures in the bank. It's at less than zero, and therefore this is not a good situation to be in. So if I were a manager of this business, or I'm a student reading this case study and seeing this problem, I need to start thinking about ways that this business could improve its cash flow. Remember, this is a forecast and it hasn't happened yet, so we can try and avert this from happening. So how might we do that? Okay, so there's two ways to improve cash flow. Number one, really simple, you increase inflows. Number two, you reduce outflows. Okay, but under those two headings, we've got various methods that we can do. Now, in yellow, I've got the methods, and in white, I've got maybe the problems with those methods, because it's really important that you know the methods of improving cash flow, but also the difficulties associated with it. Now, for every single method that you think of under these two headings, either increasing the inflows or decreasing the outflows, there are going to be issues which are probably fairly obvious for each one, but we'll just go through them. So you could either increase the selling price and hope that you sell the same amount, or you could reduce the selling price and hope that you sell more and therefore increase your revenue by either of those two methods. Okay, but obviously that's very difficult for a business to decide to do. Okay, are people going to keep on buying our product if we put the price up, or will significant numbers of people, extra people buy our product and justify us putting the price down and potentially starting a price war? So it depends on having accurate price elasticity of demand data. Remember that phrase from the marketing unit? It basically asks us how consumers will react to changes in price, and in reality that's actually very difficult to know. We could increase marketing, but obviously, if we increase marketing, what we're hoping to do is that will boost our sales. However, if we've got cash flow problems, do we really want to be spending more on marketing? Do we know what marketing is effective and what will lead to extra sales? Or will the extra costs of marketing, in fact, outweigh any extra sales and therefore be ineffective in solving our cash flow problems? We could refuse to offer trade credit. So when customers ask us if we can receive the products but pay in 30 days or 60 days or 90 days, we can say no. We want money up front. Blame it on company policy. But that could have an impact on customer service, and people may end up going to competitors who will offer trade credit. We could arrange an overdraft from the bank, something that allows us to withdraw over our limit. Basically, we can get to zero and we can keep going. But this comes with potentially high interest rate. We could sell some equity in the business. In other words, we could ask some more people to invest, sell shares in the business, or ask a partner to come on board. However, that's going to lead to a loss of control, potentially a loss of decision-making ability. Finally, we could take out a bank loan, but that might not be suitable for short-term problems. So looking at this cash flow situation, okay, it's a relatively long period. It's January to September that they are predicting that they're going to be experiencing negative cash flow. But bank loans are usually 3 to 5 years, so bank loan probably wouldn't be a suitable way of solving that particular difficulty. Okay, so we could try and reduce our outflows. How could we do that? We could ask for trade credit. In other words, we get our supplies. In the bakery, we get our flour, we manufacture the bread or bake the bread and sell it. So we've got the money in, but we ask if we can delay payment for the flour. So that allows us to have a time where we've got the money that we've generated from sales, but we haven't yet paid for the raw materials. However, this could incur an interest payment or a penalty from our suppliers who would rather they had the money up front. We could try and reduce our stock levels. This might be a sensible idea if we've got lots of extra stock, excess stock that we've kind of manufactured but is sitting around, adding to our costs because it's got to be secured, etc. And we could try and sell our extra stock. However, if we do that and run out of stock, we might not be able to meet unexpected changes in demand, or we may have to sell the stock at a reduced price, and therefore we get less money than we were hoping for if we kind of flood the market with stock that we've been holding. We could try and reduce our raw material costs, but what impact will that have on quality? We could try to cut our advertising, but will that have an impact on sales? And we could scale back any future expansion plans that we've got, so we're not investing quite so much. But obviously, that could reduce our potential future earnings. So, the key thing to remember. If you get a question on how should this business improve its cash flow, suggest a few methods, analyse them. I will try and do a couple of methods on videos on exam technique, but then you also need to consider the problems that these would lead to, and perhaps analysing what would be the best short-term, best long-term solution might be appropriate.